Good morning. My name is Vladimir Milovidov. I'm head of International Finance Department of the School of International Economic Relations of the Moscow State Institute of International Relations. My presentation today is Redefining Investors' Goals in the Post-Normal World. The first 20 years of 21st century were a period of transformation and change in the models of financial market development. There are two milestones of this process. The first is deregulation, which was a complex of reforms of the nation's financial institutions of 80s and 90s of the last century, primarily in the United States, Great Britain, and Japan. Informed the ground for changes. The second was the COVID-19 pandemic. Passing this milestone, financial market outperformed the slowing economic dynamic. According to the vocabulary of Wall Street Bets, one of the multi-members of subreddit communities of new retail investors and day traders, the term "to the moon" is used by subscribers to indicate that the securities or stocks will have a dramatic gain in overall value. There were 3 rounds of quantitative easing from 2008 to 2014. As a result of implementing these rounds, the stock market not only recovered but also reached a historical high. At the same time, record low interest rate made a traditional and conservative saving allocation, such as bank deposit, unattractive. What options did investors have under these circumstances? This figure shows the dynamics of popularity of Internet search terms in the United States in the category finance since January 2007. During the observed period, the term stock was the second most popular Internet search term after cash. More importantly, the correlations between the popularity of the search term cash and Dow Jones Industrial Average was the strongest one, 0.91. Two other popular research terms that strongly correlated with Dow Jones were deposit and invest, coefficient of correlations 0.9 and 0.72 respectively. Based on these values of the correlation coefficients, we may assume that there was a choice between investing cash in stocks and allocating it to bank deposit for Internet users. Savers' behavior was flexible enough to manage personal resources, keeping liquidity at hand. The entry of retail investors into the stock market has become ubiquitous. In 2020, the total number of new investor participants in China was over 18 million. In the United States, more than 10 million, and about the same in India. In Europe, their number has doubled. Similar process can be observed in many other countries. All new mass investors discovered entirely new ways of investing their savings. They had to refuse or change to some extent their investment preferences, which they had favored for a long time. In one of his work, David Kahneman wrote, "Organisms that treat threats as more urgent than opportunities have a better chance to survive and reproduce." This logic explained the reluctance to take risky by a vast number of people who until the pandemic had not even thought about the stock market. The loss aversion and risk intolerance inherent in majority of retail investors did not allow them to enter the financial market for quite a long time. However, in approximately a year, they have changed their attitudes about investing in risky assets. The question then is, what factors contributed to the fact that new investors began to treat the opportunities to invest in risky and profitable assets more urgently than threats of money losses? The objective of economic factors alone would not be enough to explain this behavioral transformation of millions of individuals. Most likely, certain factors nudge them to consciously and purposefully make their new choices and change their behavior. In the end, the transformation from conservative investors into risky one should have been relatively simple, low cost, and generally more or less comfortable for individuals. Gamification has become a factor that influences the emotional aspects of investors' behavior, making it more comfortable for them to enter the market. There are many circumstances determine the degree of influence of gamification on human behavior. We focused on two of them, individual and behavioral. Gamification, that is a significant increase in the gaming entertainment element and the commission-free trading application itself for private investors, appeared in a variety of screen effects that application users saw after a decision made: confetti, emoji, greetings, lotteries, gifts. No less important were the declared values that the commission-free brokers promoted among its customers. Figure presents information on the popularity of Internet online trading applications in the United States. As the researchers found out, the players from some community where they share similar emotions, common goals, and rules. As a result, the game becomes a factor determining the behavior of the community members. It can form its language understandable only to players, a unique scale of success and failures, criteria for leadership, popularity, and recognition. It is a relatively closed society with its own rules and principles, allowing some researchers to call the play a subcultural phenomenon. Thanks to the gamification of investors' behavior cultivated by Internet brokers, individuals from the moment they entered the market have become members of the emotional community and its smaller subgroups. The actions of the members of such groups become a reference for other investors, allowing them to evaluate their behavior, their place in this new area, and achieved results. This process has emotionally eased the decisions made by new investors to enter the financial market. Gamification of investment behavior has become one of the most critical emotional factors, providing an exponential inflow of mass retail investors into the financial market. As we can see, there are various groups of retail investors on social networks, which attracted millions new participants. The largest community of retail investors on the Reddit platform is Wall Street Bets, with amount about 11 million subscribers. The formation of new emotional communities in the financial market opened up opportunities for new investors to find investment tips and help transition from conservative to more risky investment behavior. Participation or opportunity to participate in such communities turn out to be additional factors that removed the apparent emotional and psychological stress that should have been present in the people entering the financial market for the first time. Communities' culture and their rules help form a sort of collective thinking and collective behavior. With this transformation, members of the communities, as they participated in enjoying activities and discussions, were not more interested in relying on independently collected and analyzed information, but collectively sharing opinions, thoughts, and suggestions on personal investment strategies. Thus, millions of market participants drifted out of sure facts to community creative observations. In the late 90s and early 2000s, the concept of attention-induced trading was developed in a scientific literature in the field of behavioral finance, according to which investors in the financial market tended to pay attention to attention-grabbing stocks and other financial instruments. The authors of this concept have proved that individual investors lacking enough information on particular stock became net buyers of attention-grabbing stocks, that is, stocks in the news, stocks experiencing high abnormal trading volume, and stocks with extreme one-day returns. Under the new conditions, with the entry into the market of numerous individual unqualified investors and the spread of online trading platforms, this trend was intensified. Today, we can extend the list of attention-grabbing indicators or signals by including these things such as other people's behavior, investment community members' observations, their opinion, thoughts, and other networking-induced signals. Thus, the investment behavior of retail investors may depend on either individually identified or collectively identified signals. The later ones will be strongest and influence the behavior of new retail investors. How are new investors' choice influenced? What grabs the attention of new investors before making an investment decision under the atmosphere of uncertainty? To answer these questions, we analyzed the data from Google Trends on the popularity internet searches of 35 terms. All searches were combined into 5 search groups. 1. Analytical searches. 2. Stock differentiation searches. 3. Trade strategy searches. Service provider searches. And finally, other searches. We then calculated the correlations between the popularity of the searches and Dow Jones Industrial Average Index. The most of the least and the least correlated with Dow Jones popular searches are presented in this table. As table shows, investors interested in the stock market terms during one of the largest bull market did not appreciate analytical searches and trade strategy searches. They focused on stock differentiation searches that helped them identify stocks the most discussed in the investment communities. The decrease in investors' attention toward equity research, stock value, and security analysis is the downside of the massive retail investors' flow on the financial market during the pandemic. Gamification of the investor's behavior, networking opportunities, and formation of emotional and subcultural internet communities had no severe impact on the market as a whole until most unqualified savers preferred to avoid the financial market. During and after pandemic, the situation changed dramatically. Through their emotional communities, millions of well-organized investors who openly ignored the objective information, data gathering, and fundamental market research gained the ability to influence and move the markets. This is the most significant characteristic of the new market model forming in the post-pandemic times. Let me conclude. First, retail investors can organize into active communities and collectively influence the dynamics of the financial market and the prices of individual securities. Emotional communities of retail investors combine the feature of social group, social network, and subculture. They have their own rules of behavior, their scales of values, assessments of success and failures of members of such communities, and their own language. The most important distinguishing feature of the investment behavior of numerous retail investors organized into emotional communities is gamification. Within the framework of emotional investment communities, networking and constant and active interaction between members becomes the essential tools of individual investors to make investment choices and investment decisions. Networking contributes to significant changes in priorities of retail investors' attention to various signals and indicators that other investors usually use to elaborate investment decisions. The fundamental indicators of financial market, the results of security analysis and analysis of the market quotes and trends play an ever-decreasing role in decision-making of particular investors. And the new model of the financial market can be transformed from centralized institutional-centric model to a distributed community-centric model. Thank you.